Affordability is a word that you have likely heard if you've been paying attention to any of these political campaigns soliciting your vote. It is a word that you likely have felt. If you are trying to make ends meet and keeping track of your budget, your family's budget, it is something that impacts all of us every day. And now we are getting some new insight into one factor that helps drive how affordable or unaffordable things feel for us, and that is inflation. There are new inflation numbers recently released that raise fresh concerns about the economy, indicating that prices have climbed at their fastest pace in nearly 3 years. We're going to bring in right now Alex Hsu. He's an associate professor of finance in the Scheller College of Business at Georgia Tech. Professor, thanks for being with us.
Hi, Zach. Thanks for having me.
So let's start kind of at a global level here. What do these new inflation numbers show?
These are pretty big prints. Yesterday and this morning, the producer price index came out as well, and it was much higher than expected. So inflation is basically changing the price level from yesterday or today or last year to this year. So that it's just that these big numbers are telling us that prices are rising faster than expected.
What's contributing to this? What's driving this inflation?
That's a complicated question because we have a lot going on in the economy. I think coming into the year, most economists believe that we're still going to feel some of the effect from tariffs from last year. So some kind of rekindling of inflation was expected because of the cost passed through by the producers. But I think the consensus was that the large tax refund that was expected this year was going to help households through this spike in tariff inflation. But the most recent development in the Middle East with the war, which is choking obviously crude oil supply and causing oil price to rise faster than we have seen in a long time, is definitely contributing to these inflation numbers.
You bring up the war in Iran, the increase in fuel costs triggered by the conflict that is increasingly centered on the Strait of Hormuz, that critical global shipping lane. How long will the impacts of this conflict continue to be felt by consumers here in the United States in the terms of the prices that they see when they go to the gas pump, go to the grocery store, or make purchases elsewhere?
Yeah, so that's a question everybody wants to know. I think as a economist, I get my kind of insights from looking at the data. For one, that the fact that the stock market is close to or at all-time highs, that tells me that the market is expecting this conflict to end fairly soon. Another thing we can look at are these kind of crude oil futures. These are contracts that traders use to kind of determine prices to trade for oil down the road. And right now, it seems like at least through the end of summer or these July contracts, the prices are elevated. But if I look at the December contracts, so how much it will cost for me to buy a barrel of oil in December, if I can lock in the price today, those prices are back down in the 70s. So maybe the market is saying that maybe we can expect it to go on maybe for another month or so.
And let me ask you this question. This is something I suspect a lot of folks wonder. I've certainly wondered it in my life as well. When you talk about inflation, prices are going up at some rate or another rate, depending on what the figures show. Do prices ever come back down as inflation eases, or is it a situation where as inflation eases, it really just means that prices are no longer increasing quite as much?
Right. That's a great point, Zach. I think there's in the public, there could be some misunderstanding what inflation is telling you. So lower inflation is telling us that price is rising at a slower rate because inflation ultimately is capturing the change in price level. When you're talking about price going back down, you're talking about deflation. That's decreasing the price level. Although generally, that's something that us as economists don't want to see because that tells you that when the economy is experiencing deflation, that means the economic activity is slowing down and possibly we're headed to a recession. So you're correct. Inflation low inflation does not mean prices going back down. It just means the price is increasing at a slower rate. But we would like to see some level of inflation in the economy, maybe at between 1% and 2%. Certainly not at the level we're seeing now.
What economic factors are you going to be watching to try to map out where all of this goes in the coming weeks and months and the rest of the year? Because I don't mean to put too fine a point on it, but it has been a fairly volatile few months in the economy here.
That's correct. Yeah, I mean, gasoline prices, I think, is probably the most salient number that everybody sees. Everybody experiences on a daily basis. You drive around the corner, you see those big numbers at gas stations. I'm expecting the numbers to come down slowly. Luckily for the U.S., we are a net oil exporter, actually, so we don't rely on the Middle East for our energy inputs. So that is good news for consumers in this country. But still, yeah, if oil prices going up around the world, we're going to feel it. So oil price is one thing because not only it's hitting our pocketbooks, but it has a psychological effect on consumers. The other thing is, it comes back down to interest rates. We care about inflation because to deal with inflation, the central bank or the Fed will have to use the tool it has to combat high inflation, and mainly that tool is interest rates. So higher interest rates, it will lower inflation, but it will also slow down economic activity, and because it will cost more money to borrow either on your credit card or companies to borrow to finance investments. So interest rates is something that will reflect a lot of what's going on in the economy. So that's definitely an indicator that I'm paying close attention to.
Professor, we're a little short on time, but I would be remiss if I didn't ask about this. You bring up interest rates, and that is something that is front of mind for so many Americans, particularly so many young Americans who are trying to break into the home market for the first time and become home owners. I think a lot of folks in their 20s and their 30s and 40s and perhaps at any age group remember in the COVID era and the few years following the sort of 2020, 2021, 22 era of our economy when interest rates were terrifically low and people were getting mortgage rates that were historically low. Some folks took advantage. They bought a home and they're paying at that mortgage rate now. Others, for whatever reason, it wasn't the right time for them. They weren't in a financial position. They didn't want to do it. They didn't get into the housing market at that point. And now, if they want to, a few years later, they're looking at interest rates that are much higher. I think in the back of the mind of a lot of those folks, people are thinking, well, maybe the rates could go back down to those levels of the COVID era. Is that a realistic hope, or are those days done and gone?
I think it's realistic. So, as economists, we would like to think of the world in regimes over time. I think we're in a very low inflation, low interest rate regime since the 2008 financial crisis for almost 12 years, so more than a decade. Now, I think we're in a new regime after COVID, in this higher inflation, higher interest rate era. So it's possible for rates to come back down to the previous regime numbers, but it might take a while, a decade or so. In the meantime, we'll just have to manage and make really smart decisions with our money. Deciding what are the items that's really important for us to spend money on, and when should we borrow and not. That's a tough economic homework question, but yes, it's possible. But I mean, ultimately, I think in this country we'll have a housing supply shortage. That's one big issue. Why affordability is such an issue in the housing market. But yes, inflation and interest rate play a role. I think short term, once the war is over, we can expect some relief on the interest rate front. But for mortgage rates to go back down to the kind of COVID era numbers, it might take a long time.
All right, we are out of time, unfortunately. Professor Alex Hsu, at Georgia Tech, a professor of finance. We're going to have to bring you back on to talk about the home shortage situation in America, as that is a topic that I know a lot of folks are paying close attention to as well. And I'd love to talk about it now, but we're out of time. We'll bring you back. Professor Hsu, thank you very much.
Thanks, Zach. Happy to do it.